All right. I think almost everybody that's here knows that we have two open deals in the club right now. First one is the Alternative Investing Club Fund. This speaker is not part of that fund. This is an educational talk. And I'm looking forward to it too. Salt Lake is an area that's been very much talked about this year in terms of being a destination spot for investing. And the other deal that we have open is an oil and gas deal situated in Colorado. And I've had quite a few conversations with some of you. I did get locked out of my Gmail account for a day on Wednesday. So I wonder if something that had something to do with it. But anyway, if you have any questions about those, feel free to email me, Daniel at alternativeinvestingclub.com or Daniel at goodsamaritancapital.com. And now I'll turn it over to Jason. Jason, welcome to the group. Tell us what you do and how you do it.
Yeah, hi, everybody. Firstly, thank you for having me. It's a pleasure to be here. Miter P Company is my company. I started it in 2020. It started off as a fee-based developer and an acquisition consultant and operating partner, and it is transitioned into an investment company as well. We focus exclusively on industrial real estate in the Intermountain West and Southwest, middle market industrial real estate in the markets of Salt Lake City, Denver, Phoenix, and Las Vegas. And today we are going to talk about and focus on the Salt Lake City industrial market and the greater Wasatch Front metropolitan area. So we'll get right into it. Just a quick overview of some of the projects that I've been involved in over the past 4 years. This one in the upper right-hand corner, that's 420,000 square feet spec development we did in the Salt Lake market. We broke ground in summer of 21, and we just exited to, my partners and I exited to Exeter this summer. In the upper left-hand corner, this was a 330,000 square foot spec industrial project in the airport submarket that was sold to Nuveen in 2020. That was done as a fee developer. And in the lower left-hand corner, this is a multi-phase, multi-year, 100 million square foot industrial project that we've been working on with some partners for many years now. It's a public-private partnership between the city and the Water Reclamation District that owns the land and us. So that's what we focus on predominantly. My agenda for you today is to cover these topics, give you a very general overview and orientation of the Wasatch Front in Salt Lake City. We'll talk about at a high level what makes the Salt Lake City industrial market tick from a demand perspective. As investors, I firmly believe we should know and understand very clearly what are the demand drivers for the groups occupying the buildings that we build. Then we'll talk about the key drivers of industrial demand, and then we'll take a very high level nickel tour of the major Salt Lake City industrial submarkets to give you an orientation if you're ever looking at opportunities in this market. And then we'll close it out with opportunities and challenges of investing in this market. So we'll start with what is the Wasatch Front? The Wasatch Front is a 120-mile developed corridor. At its widest, it's 18 miles wide, and it runs from the south in a town called Santaquin, which is south of Provo, and it runs all the way up north just to about the border of Utah and Idaho at Logan, and Salt Lake City and Salt Lake County are right in the middle. So in this talk, we'll talk about Salt Lake County, and we will talk about Utah County predominantly. Those are the major markets, but we'll cover some of the other areas as well. I didn't mention this at the top, but if you have any questions, we'll cover them at the end. Feel free to add them to the chat, but I'll save for all the questions at the end. It's important to know geographically what moves this market. It's a very narrow market for geographical and geophysical reasons. The Wasatch Front is a mountain range that actually stretches 160 miles from center Utah up to Idaho, and that forms the eastern boundary of the Wasatch Front. And then on the west and the northwest, you're bordered by Utah Lake here, the Oquirrh Mountain Range, which is here, and then the Great Salt Lake to the northwest. So it's a very linear metropolitan area, home to about 2.8 million people in total, so quite spread out, and 1.2 roughly million square 1.2 million people occupy the Salt Lake County market, and another 700,000 people occupy the Utah market. So again, those are the major markets. It's important to understand how Salt Lake City and the Wasatch Front fit within the greater context of the West, because it's very important to industrial users, especially distribution and warehousing users. So many people in many industries refer to Salt Lake City as the crossroads to the West, and for good reason, because it really is smack dab in the middle of the Western region. It's referred to as the Intermountain region because you've got the Rocky Mountains and the Front Range along Denver to the east. Then there's really kind of a basin in the middle, and then you've got the Sierra Nevada and the Cascade Mountains to the west and the northwest. But in the middle, at Salt Lake City, there's a confluence of interstates. There's a confluence of rail and a major international airport, and Salt Lake City is a second-tier metropolitan area. That what this map is showing is this sort of middle orange color here. That represents an 8-hour drive time. So within 8 hours of Salt Lake City, you can be in Reno, Boise, Bozeman, Denver, St. George, Las Vegas. Very important from a distribution and manufacturing perspective, because there's limits and regulations around how many hours a truck driver can drive. And so for a truck driver hauling further east, Salt Lake City is a major stopping point before it can really, kind of take its next leg, going further east. So there's about 33 million people within this middle orange area. So, a very large population to serve within this area. The Salt Lake industrial landscape is predominantly made up of these 5 categories. It's a manufacturing hub, it's logistics and distribution, it's energy and clean technology, it's food and beverage processing, and it's emerging industries. As far as manufacturing is concerned, it's home to a thriving manufacturing sector with a diverse array of industries, including aerospace, automotive, and medical device production. So some of the large names and occupiers here in those industries are Northrop Grumman, Boeing, Lockheed Martin, Hexcel, medical device and nutraceutical manufacturers such as BD, Stryker, Edwards Life Sciences. And then in the automotive industry, there's companies that specialize in specialized components manufacturing and aftermarket products. For logistics and distribution, again, as we just covered, and we'll cover more in this topic, the strategic location and well-developed infrastructure make it a key hub for logistics and distribution, with major warehousing and fulfillment centers. So your Walmarts, your Amazons, your Targets, your Wayfairs, and so on, they're all major occupiers here, serving a super regional and regional area. And there's also energy and clean technology. This isn't energy per se, but I forgot to add it in here. But Salt Lake City and the Greater Wasatch Front is also a major miner of minerals and raw materials like copper, gold, silver, lithium, phosphate, and aggregates. Rio Tinto being the largest mining company in Utah. So we export a lot of natural resources as well, which makes the proximity to other markets and the ports incredibly important. Back to energy and clean technology, it's home to a growing number of companies focused on renewable energy producing, battery technology, and sustainable materials. Companies such as Dominion Energy, Rocky Mountain Power, Vivint Solar, and AES, just to name a few. Food and beverage is a significant contributor in industry here. We've got a robust agricultural base and its attendant logistical hub. It's home to a mix of large-scale production facilities, artisanal producers, and specialty natural food producers. Some names of such producers are Nestle's, Kellogg's, PepsiCo, and many others. And then we have emerging industries that are growing very rapidly, such as data centers, software development, and biotechnology. Data centers is big business across the U.S., as we've all heard by now. Utah being a major benefactor of that because of its geographic and geologic stability, its energy efficiency with its cooler temperatures and energy availability, its infrastructure and economic incentives provided by the state. Facebook or Meta, Texas Instruments, and Nova, just to name a few, are several that have set up large hyperscale data centers here. Software development has been ongoing here for some time now. Our software and tech hub in Utah County, christened Silicon Slopes many years ago, is home to a growing number of tech companies driven by skilled tech workforce and very supportive business climate. And lastly, biotechnology has been growing here due to partnerships and support by research institutions at U of U and BYU. And they're focused primarily on innovations in medical devices and pharmaceuticals. So a very diverse, very robust set of industries here feeding into the industrial landscape. So putting our minds into the mind, or our thoughts into the mind of an occupier, why do they want to be here? I'll start with the image on the right. This is a little bit more clear picture than the one a few slides ago about the intersection and the crossroads of the West here. It's a strategic location in the West. I won't repeat the number of cities that you're close to within a day's drive, which is important, but it's a confluence of several north to west and east to west, or north to south and east to west interstates. I-80, I-15, I-84 are the major ones, and I-70 that cross through this area. US or BNSF and the Union Pacific rail lines cross through here. The Golden Spike that tied the East and West railroads together is in Utah. And it's a diverse industrial base, so the ecosystem of other industrial suppliers and customers is important to be close to. Supply chain proximity is important. We talked about infrastructure and a business-friendly environment. We'll go into some more of the details on these things in the coming slides. Salt Lake City is also home to an inland port, and the Utah Inland Port is a logistics and distribution hub designed to streamline the movement of goods through the Wasatch Front and onto destinations. What is an inland port? For those who don't know, it is truly an inland port. It's inland because it's not on the coast, and goods can be moved inland without full customs clearance at coastal ports, expediting shipping. So not everything has to go through full customs at at the seaports, they can move inward to a regulated inland port and then distributed from there. So it reduces congestion, it reduces transit time and cost for businesses. And the inland port supports bulk distribution, warehousing, and e-commerce. It's also important to know, as we talked about the railways that intersect here, the Intermodal Hub. What does intermodal mean? It means it's the intersection of multiple modes of transportation. So highways, rail, and air, sometimes sea or water. We have an intermodal hub that serves most of those except for water. The Salt Lake City Intermodal Hub is a confluence of rail lines from BSNF and Union Pacific, where trucks can either offload materials onto trains, or trains can offload materials onto trucks and distribute them either super regionally and nationally or locally. We talked about the rail serving Greater Salt Lake a little bit. These rail lines tie Salt Lake to all of the eastern United States, Chicago being one of the first stops along the way. And then on the west, there's connectivity to all the major ports, so SeaTac, Oakland, Las Angeles, and Long Beach, and San Diego. So drivers, going a little bit deeper into the minds of occupiers, what are the drivers of industrial demand, and why does it matter for Salt Lake City and the Wasatch Front? I'm sure it's probably obvious to most that transportation costs are a primary driver for distribution and supply chain site selection. Frankly, diesel costs are expensive, and transportation costs often make up 50%, sometimes 80% of an operating budget of a distribution or logistics company. The Wasatch Front offers low congestion, it offers low diesel costs, efficient access to multiple modes of transportation. Labor availability is very important, especially for manufacturing, but also for warehousing. And it's important to have a cross-section of labor, everything from unskilled labor, semi-skilled, up to skilled. And the Wasatch Front offers a great spectrum of labor availability. However, if we're weak in any area, it's on unskilled labor. We're very strong in semi-skilled and skilled labor, not as strong as places like Las Vegas and Phoenix for unskilled labor, or Los Angeles for that matter. Supply chain proximity. Supply chains tend to cluster, and they tend to form an ecosystem. So larger producers of something tend to have an attendant supplier ecosystem within 30 minutes to an hour, sometimes 2-hour drive of their location. So they need to be close to suppliers, they need to be close to customers, and distributors need to have access to those things. Wasatch Front is a benefit because it's close to natural resources that we'll get into, and some of the basic building blocks of the supply chain, as well as the sort of intermediate components and sort of final product within the market. Operational costs are everything else. It's the tax environment, it's your facility costs and leasing costs, it's your utility costs, it's your labor costs. Frankly, it's expensive to do business in California, and that's a huge benefit to states like Arizona, Nevada, and Utah from that perspective. Wasatch Front has favorable tax incentives, relatively low tax costs compared to the West Coast and other markets along the coast. Favorable regulations and low utility and labor costs. And then utility infrastructure. Frankly, manufacturers and many distributors need to know that they can rely on the utility services, especially for larger industrial users and manufacturers. I would say amongst the utility companies in the US, we have relatively very forward-looking utility companies that do plan for the future and for future growth. So now I want to take you through just some very specific slides. I'm a sucker for charts that kind of dig a little bit more deeply into those things that we just covered. Here's a chart depicting Utah's diesel cost per gallon compared to other Western states like California, Nevada, Washington, Arizona, and Colorado. You can see it's in the lower half of Western states. Largely, diesel costs, especially in states like California and Washington, they can be much more expensive due to tax and excise taxes and other regulations around those costs. Utah is a favorable environment for that. This chart depicts the concentration of employment in warehousing, logistics, and manufacturing. So the location quotient essentially measures the concentration of employment within these industries compared to the United States as a whole. So a value of 1 represents the United States. So in Utah, we've got a strong concentration of production workers as a percentage of overall employment, and a strong concentration of truck transportation and logistics employment, a little bit below the United States as a whole in warehouse and storage, but that is slowly growing. As to be expected, other markets like Arizona, California, and Nevada are better in the warehouse and storage employment currently.
Hey, Jason, why is Nevada so much larger than the others there?
That is a good question.
It's centrally located, yes, but
yeah, I would, if I had to guess, and I haven't dug deeply into why this is, but I'm going to imagine it's a lower cost of living and proximity to California, but I mean that would also apply to Arizona as well. So there's some other factor there that I'm not really sure.
Okay. And I'm having a little trouble hearing you. Could you speak a little closer to the microphone? Thank you.
Sure. How's this?
Yep, it's better.
Okay.
And I definitely have been queuing up my questions instead of putting them into the chat. If people do have questions, put them into the chat. But I want to go back to what we don't have to do that right now, but I want to go back to what the costs are to modify a building to service one industry versus the other, and just what are the budgeting logistics of doing that?
Sure. This we'll come back to that. This chart depicts the Greater Salt Lake major industry supply chain input region of origin. And what this is saying is these are major industries within the Greater Wasatch Front: advanced manufacturing, aerospace, energy and natural resources, life sciences, outdoor recreation, etc. What this is showing is that the inputs into these industries that are based here primarily come from this market. So it's a fairly self-sufficient market in its production sense, and the rest predominantly comes from the rest of the world in terms of inputs. You can see these very thin blue lines represent very little input from the rest of the United States in terms of these industries and their production here in the States. So it goes back to that ecosystem. These are, there's a strong ecosystem within these industries, and if a user wants to relocate to this industry or to this market, they can tap into an existing ecosystem. These charts compare corporate taxes and property tax burdens in select Western states. Washington and Nevada have no corporate taxes, so they certainly have a leg up there. But amongst the Western states, Utah is on the lower end, certainly considerably lower than California. And on the right, property taxes, Utah falls in line with most of the Western states, except for Washington and California in terms of cost of property taxes. So, there's again, since I do business in Arizona and I do business in Nevada, there's been a conversation going on for the past 6 years, honestly, but especially in the past 3 years of the California factor, the California exodus, that occupiers are throwing in the towel on California in many cases, because they can distribute to cheaper locations and still be within a day's drive of major population centers. They can take advantage of lower cost of doing business and operating costs and labor, and so many are choosing to do that. These charts compare the cost of labor in manufacturing and in warehouse and storage in Utah compared to Western states. So for manufacturing labor, Utah actually is the lowest amongst these states in average wage per hour. And then warehouse and storage labor is that Utah's amongst the lowest for that labor. Energy costs and industrial lease rates, Utah is very affordable in terms of $1 per kilowatt hour. This depicts all sectors, but even in industrial uses, Utah is amongst the lowest, sometimes the lowest in terms of $1 per kilowatt hour. And then occupancy lease rates of industrial space. Boise is a little bit cheaper, but Boise is not really comparable in the market size as Salt Lake City. So a lot of, there's just great options here for occupiers. CNBC ranked Utah fourth in its 10 best states for infrastructure, stating Utah's roads and bridges are amongst the best maintained in the nation. Utah's power grid is amongst the nation's most reliable, and broadband connectivity is excellent. So these things are very important for a number of the users that we've discussed. These charts depict the young population of Utah. Utah is the youngest state on average by far. And this top chart shows that 32% of Utah's population is under the age of 20, which is considerably higher than the next lowest state of Texas, which I don't have the number in front of me, but I think there's something like 22% to 25%. And then the population tree chart in the lower left is sort of the ideal population tree. I think many countries would salivate over a population tree like this. It shows a very young population, which represents sort of built up expanding workforce and consumer pipeline, an increasingly educated population. It'll benefit sectors such as semi-skilled and skilled labor. It represents long-term economic stability, as you have more inputs producing in this economy in Utah relative to smaller consumption bases of older populations. These charts represent and depict population growth and job growth in Utah. This top chart shows that since 2015, between 2015 and 2023, Utah in total grew just under 15%, and it was amongst the 4 fastest growing states over that period, inclusive of Idaho, Nevada, and Florida. And this chart in the lower left-hand corner shows the projection of job growth from 2022 through 2023 in Utah, representing a 23% total job growth over that period. And you can tell by the shading that it's much higher than many other states. I mean, even Texas is projected to grow about 15%. So Utah is a fast-growing state in many respects. The fastest growing industrial sectors in Utah by GDP and employment demonstrate high growth in high value industries like information technology, healthcare, finance, and professional and scientific and technical services, while also growing in logistics, supply chain, and basic materials industries like transportation and warehouse, mining, utilities, and agriculture. And what this means is that Utah's diverse economy and high population growth will continue to foster growth within the greater industrial sector. Growth plus diversity equals more demand for the industrial real estate sector here. Okay, so that's enough for charts. Now we're going to switch gears and do a very high-level nickel tour, just to orient those who perhaps have not spent a lot of time here of this market and the various submarkets, and give you a flavor of what they each represent in this market. So Salt Lake County is a valley. As we discussed, it's bordered on really all four sides by either mountains or lake. And it is the primary industrial market here in the Wasatch Front. It has the Intermodal Hub that we discussed. It has the broadest labor spectrum within the Wasatch Front. It's the home of the major transportation terminals and carriers. And it's home to key industries like logistics and distribution, e-commerce fulfillment, manufacturing, aerospace, bulk distribution, service industrial, and construction materials and fabrication. One growing characteristic of Salt Lake County, though, is supply constraints. And that is largely driven by the physical constraints of it being in a valley. And it is there are now regulatory constraints that are starting to grow as municipalities start to say that they feel like they have enough industrial and, send the warehouses and distribution centers somewhere else. Still continuing with this market, I want to just give you a kind of a bird's eye view. This circled area here is called the Northwest Quadrant. This is the main or ground zero of the industrial market here. This is where you have the largest occupiers, the Fortune 500 companies, the national companies, the biggest, distribution. It's also the location of the Intermodal Hub. It's the location of the Utah Inland Port, and it's the confluence of multiple major transportation corridors and the airport. Along the central spine, along I-15, this is your older historical sort of service-based, locally serving manufacturers, service providers, distributors, smaller buildings, oftentimes a lot of power built, somewhere probably between the 60s and the 90s for the most part. A lot of rail-served companies are located here as well. And then in the southwest portion of the market is a growing bulk distribution part of the market. This Highway 85 that passes through this circle north to south, that completed its loop from State Route 201 to the north to I-15 to the south in, I think, 2019. And once that opened up that loop, then many developers started to set up shop here, and because of the reducing supply and footprint of available land in the Northwest Quadrant, it naturally opened up this area for industrial development. So you've got large format bulk users here. There's 1 million square foot Amazon. There's actually a couple of Amazon fulfillment centers down here, but also sort of mid-sized regional distribution centers, suppliers, and manufacturers down here. A quick look at some very basic stats. Like most markets, industrial markets in the United States, there was a large wave of new supply between 2021 and 2023, largely driven by the increase in demand. When we were all stuck at home, supply chain bottlenecks, and low interest rates and so on. So once interest rates started rising, supply chains eased up. Supply started to outpace demand, and naturally that leads to vacancies increasing. However, I think compared to places like Southern California or Phoenix, there wasn't as much overbuilding, and demand has remained very strong. If you look at net absorption in the lower left-hand corner, net absorption, aside from a half-year-long lull in the beginning of 2023, it's actually maintained a pretty healthy clip compared to pre-COVID years. And Meanwhile, in the lower right-hand corner, construction starts have virtually plummeted. And so we have a temporary supply surplus, but it's being worked off at a healthy clip. And so what that has led to is, we had experienced 14% year-on-year market rent growth, which is crazy. That's not sustainable, but it hasn't fallen through the floor. Market asking rent growth remains positive. Concessions certainly have picked up as all the developers that have delivered at the same time are, trying to get their spaces leased up. But there's no blood in the street, and it's not coming. Demand is going to stay, consistent, and it's going to work through this supply. And then there's going to be a bottleneck again because it takes time to bring new development out of the ground. Okay, we've got a few more submarkets to work through. Utah County, this is south of Salt Lake County, home to key industries like nutraceutical manufacturing and supplements, health and beauty manufacturing, regional distribution, and food manufacturing. It's a very entrepreneurial submarket. I would say, it's a very strong hold of the LDS faith, which is, if I can generalize, is a very entrepreneurial, culture. And people start companies, whether it's in tech or whether it's in manufacturing or whether it's service-based. And so a lot of the industrial base here started out of kind of, smaller scale manufacturing that has then since grown to regional and national. The future potential here is that this is where the puck is going in terms of industrial development. Many developers got a little ahead of themselves in this last cycle, and in the south half of Utah County, overbuilt kind of larger bulk in distribution centers, thinking that occupiers would want the lower cost and the closer proximity to the ports and I-70. That thesis was probably a few years too early. And so some of those larger buildings are sitting uncomfortably vacant right now, but the smaller flexi industrial, the smaller service-based industrial is experiencing strong demand. But the growth is moving in this direction. Utah County is a fast-growing county, both in terms of aggregate numbers and year-on-year growth. North Utah County is kind of home to more mid-sized distribution users, kind of a little bit of an overflow from the Salt Lake County users, and some of those manufacturers are here. And South Utah County, again, is where there's too much distribution right now. It will make sense at some point, but it just was a little too early for those large users. Very similar stats in aggregate to Salt Lake County. Vacancy shot up as supply delivered, but again, look at net absorption in the lower left-hand corner. It has remained very healthy, very strong, and it's predicted to continue to do so. Meanwhile, construction starts have fallen through the roof, and that will ultimately lead to a rebound in year-on-year market rent growth. These last few are not as major, but we'll flip through them. Davis and Weber counties, these are north of Salt Lake County, so you can see Salt Lake City on the south here. Davis and Weber County are from North Salt Lake to Ogden. Key industries here are mostly driven by agriculture and aerospace and attendant industries to the Air Force Base up there. So aerospace, defense, electronics, cold storage, and rail served industries. It is emerging as a spec development market, again, kind of an overflow market as supply constricts in Salt Lake County, but still the 50,000 square foot users are still trying to stay within Salt Lake County, but these counties are still strong for, say, the 20,000 square foot user or 10,000 square foot user. This is South Davis County. It's this pocket is rail served industries. There's a refinery, an oil refinery here in the north side of Salt Lake, and there's many attendant suppliers and industries here that serve that around there. In the middle part of these counties, it's the Hill Air Force Base here and the Freeport Center here. Freeport Center is one of the largest single industrial parks in the Western United States. It houses 7 million square feet of warehouse, manufacturing, and distribution. It started out as a naval supply depot during World War II and is now an industrial logistics and warehousing park, and has synergies with defense contractors and aerospace companies due to its proximity to the Air Force Base. And in North Ogden and North Weber County, the business depot in Ogden is here. It's rail served. Again, it was originally a U.S. Army supply depot that was ultimately redeveloped into an industrial park, and it houses tenants like Home Depot, Wayfair, and PepsiCo. A bit more attractive in terms of vacancy rates and fundamentals, because there just simply wasn't as much overbuilding here. The building was more focused in this last wave in Salt Lake County and Utah County. So good fundamentals here, especially if you're targeting kind of smaller users from 2,000 feet to 20,000 feet and service-based industrial. Tooele County, I think it's something to keep on the radar, but just put on the back burner. This is west of Salt Lake City. Salt Lake City County is here on the right side of these Green Mountains. It was historically a Army depot and improving ground. It serves heavy manufacturing and kind of dirty manufacturing and dirty industrial and rail related uses. It is very, very, very nascent as a potential bulk distribution submarket. There's a lot of land out there. It's basically desert, but the infrastructure simply isn't there yet, and it's many years away. There is a strong employment base that is a captured, asset there. The majority of residents commute to neighboring counties for work. So in the future, there's planned a bypass from I-79 here that will come around down to I-73 here. That would be a truck bypass. And when that happens, it's not funded yet. This is many years away. That will create a loop from northern Utah County through Tooele County and then over to the northwest quadrant in the airport area. That will be huge. At some point, this will become a very strong bulk distribution and warehousing, but it's just a little too soon for that. This is an aerial. You can see this is an old Army depot, distribution center, rail served. And then the last submarket, and then we'll quickly touch upon pros and cons of investing here. The last submarket is in Box Elder and Cache counties. This is very northern Utah. It's very much driven by agribusiness, farming, food manufacturing, aerospace and defense and packaging. The majority of development up here has been large build-to-suit manufacturing for end users, but it is expected to emerge as a spec development market in 7 to 10 years. From this aerial, you can see, miles and miles of farmland, but in the corner here on the left, there's a large Procter & Gamble plant, and there's many other large facilities like that, but they're just interspersed throughout the geography. You can see here construction starts. There was this large blip here in 2023. That was a build-to-suit user, so that theoretically shouldn't be spiking the vacancy here, but it's kind of a slow going. It's a build-to-suit market right now. And then what I want to wrap up for a few minutes and give you guys time for a few questions is what are the opportunities and challenges of investing in this market? The opportunities are high barriers to entry. So land constraints is one of them. In places like, Phoenix, you can just keep going out and out and out and out and out. And that is true to an extent in South Utah County, or if you really go north into Box Elder and Cache Valley counties, but because of the linear nature and where the confluence is of the transportation corridors and the intermodal, connectivity, there's a limit to how much of that growth will happen. Population and economic growth, e-commerce and logistics expansion. There's many pockets of underserved submarkets that really didn't get overbuilt in this last run-up. There's cultural barriers to entry. It really takes time to build and establish a presence and connectivity and relationships here to see the kind of deals that others that have been here for a while are seeing. This has very much become an institutional market, and it continues to grow as an institutional market, which means, upside potential on the back end. Utah County is growing as an institutional market, but it's still not there yet. But groups like Exeter and Lincoln Property Company are buying assets in Utah County. And then supply chain optimization and other supply constraints like regulatory issues like we talked about are putting constraints around new supply. So it makes it a good investment market when you can find the right deals. The challenges are it's a very competitive market. There's the things I'm sharing with you are unfortunately are not a secret anymore. So there's a lot of groups competing for deals. It's an opaque market. It's not it's not an open market where transactions have to be published. I mean, they're published, but like the purchase prices aren't published in the county recorder. It takes time to get established, like we talked about. It's a relatively low transaction volume, so it takes time to get deals going here. Community fatigue of new industrial, cyclical softening in submarkets, and a low stock of large functional Class B and C assets with a lot of meat on the bone, to spend say $20 or $30 million on an asset that you can reposition into something Class B plus. There's a relatively low stock of that, so there's a lot of competition, and it's still a relatively small market compared to places like Denver, Phoenix, and certainly Lower California. So I want to leave. Sorry I ran so long. I want to leave some time for questions, but that is my presentation, and thank you for listening.
That was a great overview of the area, and I was just going to remind you to put your company name up on there to make sure that people, if they want to, can reach out to you and follow up with you. So if there are questions in the chat, we can go with them. There was so much data that was there. I was curious, when you're evaluating a particular investment property, what data really goes into your calculations there for not just the area, but for a particular spot?
Yeah, I always take. Go ahead.
Go ahead.
I always start with a top-down approach. If someone sends me a deal, if a broker sends me a deal, I immediately say, why would an occupier want to be here? What is the long-term backstop of demand for the space? And that would include, with all industrial, proximity to interstates and major transportation corridors. But I also would look at it like, well, what kind of users are going to want to be here? Some users want to be in a location because of their proximity to other suppliers and customers like that. So I start there, and then I look at the number of months in supply. I'll narrow it down to the type of products. Okay, this is say it's an 80,000 square foot rear load industrial warehouse in the Southwest Valley. It's going to attract a different kind of user than wants to be in the Northwest Quadrant. What are the supply and demand dynamics right now for that size building in functionality? And I'll calculate the number of months of supply first off. What's the availability in absolute terms? How much uncommitted is under construction that is competitive? Divided by the net absorption over the last 12 months and annualized last 2 quarters. And if it's if that number is less than 24 months, then I'm pretty jazzed about it. If that number is 40 months, I'm cautious. Then I need more of a story. And then when I get into the details of the deal, I look very, very carefully at the functionality of the building, its clear height, its access, its truck courts, does it have dock high doors, bay spacing, and so on. So that's generally how I go about it.
I was curious about this, as I think a lot of people from Intel on this call probably are, but you mentioned data centers earlier on. How costly is it to convert a building to a data? Is that one of the more costly types of conversions? And what does, when you buy a building and it's got the essential characteristics that you want for the type of product and the type of suppliers that are going to be there, what does it tend to look like when the group that takes it over goes and modifies it for their own use? How long does that take? What sort of budgeting goes into it?
Well, to start with data centers, I don't play in that world because it's a very specialized world,
Niche.
and it's very niche, and it's dominated by large players. It's the adage of no one's going to get fired for choosing Blackstone to build, tens of millions of dollar, $100 million data center for them. So I don't get involved in that too much, but primarily data centers are about two things: power and water. And power is actually the bigger constraint for most data center users these days than water is, surprisingly, even in drought-prone places like Phoenix and in Utah. So they're finding power. They're getting creative. Like the electrical power providers like Rocky Mountain Power have actually put a moratorium on large load studies like that. So now data centers are looking to the gas companies and say, okay, well, let's do gas-powered on-site power plants, natural gas power plants on site that we will own to power our facilities. And that's how they're moving forward today. In terms of modifying buildings, I mean, look, probably it depends on the kind of user. I mean, there's so many different flavors of industrial, but a warehouse, let's just say a 200,000 square foot warehouse and distribution center that's got a clear height of 24 feet or 32 feet, something similar to what you see in the image here. Most of the users are going to be warehouse and logistics. So it's going to be racking and aisles of racking. They may have they might have a 1,200 square foot or a 1,500 square foot office. Sometimes it's bigger. But so there isn't really a lot that goes into making these spaces occupiable for the users, which is actually one of the really nice things about industrial compared to office. When office was more of an attractive investment, is office is incredibly capital intensive to outfit for a new user. For the most part, industrial is not. You rarely have to give a very large allowance to get them occupied. There's market rates that you offer, and if they want more, then you amortize it into the lease. But let me ask, does that answer your question? Is that helpful?
I think it does, yeah. And we only have a minute or so left. And so does anybody have any questions that they want to pose to Jason? And if not, we'll simply ask everybody on the call to take themselves off mute and thank Jason for coming in and talking to us today. I really enjoyed your talk.
Thank you, Jason.
Thank you, Jason.
Thank you.
If you do have questions that are burning a hole in your mind, feel free to reach out, and I'm happy to chat with you.
Thank you.
Thank you.
Thanks all.